September the 18th, 2025, and you're in Genus's introduction to our new commodity strategy. Hi, I'm Wayne Wachell. I'm the Genus CIO, and with me I have Stephanie Sui, our Chief Sustainability Officer, and Justin Hahn, our macro strategist. I'm going to do a bit of an overview. Justin's going to dive into the strategy, and Stephanie will review the strategy from an ESG impact perspective. Now at Genus, we are committed to meeting our clients where their values are. And because of that, that means we have to have a pretty big lineup of strategies or products to meet different values across the spectrum. And so here is our lineup of sustainable products across the spectrum. And you can see here, it's broad, it's diverse. And the far left is what we call our ESG limited. And this is the strategies that are focused on performance, but have limited ESG integration. And our research indicates that ESG integration, to some extent, helps reduce risk in portfolios. That's what the research bears out. At the far right now is our impact strategies, and they're focused on both performance and purpose. In the middle is our fossil-free strategies that screen out hydrocarbons and also screen out ESG risky type stocks. And we also have low carbon across, lower than benchmark carbon across the whole space. With our new commodity strategy, we've created a new category called transition. It's not quite fossil free, but we think it's appropriate for some of those clients. Steph's going to talk about that. And it also means we've added another alternative to our lineup, and we're excited about that. We have more coming next year, we hope. So why commodities and why now? Well, apart from providing protection from inflation, enhancing diversification, commodities tend to do well during bear markets. Now, I know we're in a bull market right now, but bear markets do come and go. And let me show you some evidence. We started this chart, I think we first produced this chart back in 2001, 2002, after the internet bubble. And with this chart, we've gone back to 1871 and looked at the returns of the S&P 500 in real terms. And so it's returns of the S&P X inflation. And so what we've done is, you can see the diamonds, the purple diamonds, they delineate the barriers between a bull market and a bear market. And you can see, for example, if we go into 2000, let's go between 1981 and 2000, there was a bull market there, and the cumulative returns, real returns over that period were 270%. And if you go back, the previous bull market was 264, and then the one from 21 to 31 was 203, and then the one in the 1800s was 133%. And then we also have bear markets. You can see, we classified last bear market from top of the internet bubble to about 2007 or 2008, that would be obviously. And that was real return loss of 63%. In the 70s, you had a real return loss of 38%. And it was a little more positive because there was serious deflation back in the 30s. So there wasn't much inflation, there was deflation. And then in the between 1901 and 1921, there was real returns. So you tend to get really bouts of strong real returns in bull markets and negative real returns in bear markets. And so what we did then is that we looked and said, what are the returns of stocks and commodities in these various bull and bear phases? And so on the left here, we have what happens in a in a bull market, when during a bull market, you can see that, of course, as you would expect, stocks on average have earned 261% cumulative. TSX, more commodity oriented, hasn't done as well, obviously. Copper, which is more economic sensitive, has done quite well. Gold flat, silver up, and oil down. Now look at a bear market. To the right is bear market. You can see that the S&P minus 13.6, TSX minus 14% in real terms, and oil up 107%, gold up, silver up, and copper up. So if we're in a bear market, and they will come at some point in time, we expect a commodity fund to provide some protection in that kind of environment. And there's other benefits too, which Justin's we'll talk about as well. So what we've done is we went out and interviewed some commodity managers, looking for some experts, and we've hired Auspice as a sub-advisor to help us manage the fund. They're out of Calgary. Their founding partners were from Shell and TD Security, so they have experience trading commodity before they started their new operation. They're very institutional. They have very structured, disciplined process. You could say it's something like our process, quantitative. They employ futures, which allows you to move faster and get involved in taking delivery of real commodities. They do manage institutional money for some of the biggest pension plans in Canada, and recently they were awarded a mandate by Concordia University to create a mandate very similar to ours, and Steph will talk about that. So we're very excited by this. We think it's going to add value to the portfolio for our clients in different ways. And now Justin's going to dive into that and tell you more.
Thanks, Wayne. As Wayne mentioned, today I'll be going over the commodity fund that we launched last week and its benefits. So the commodity fund is a long-short strategy. It's a CTA strategy and sub-advised by Auspice Capital, as Wayne mentioned, who are one of Canada's largest commodity and CTA fund managers. The goal of the fund is to provide inflation protection as well as diversification during the high volatility periods. In addition, we did incorporate some sustainability considerations into the fund with certain exclusions, such as no long fossil fuel exposure, but we can go short and omitting some of the commodities completely. Stephanie will go into that in detail a bit later. We are also seeing a bit of a demand for commodities with the countries building up their own infrastructure and being a bit more nationalistic due to the tariffs and all the geopolitical threats, which also ties into the green transition. As mentioned, the goal of the strategy is to provide a negative correlation to traditional assets such as equities, bonds, and cash. The fund aims to provide the downside protection while also enhancing portfolio returns. And this is done through investing in a wide range of commodities. More specifically, the fund is trading within 70 markets within 7 different sectors using futures, which are very cash efficient. The commodities range from metals such as gold and grains to currency exposures and softs such as sugar. And you can also see on the very right-hand side here that the fossil fuel exposures, we are either going flat or short only, and we're not going long. So why did we look to diversify now? So looking at the correlation between the traditional assets of equities and bonds, over the last 80 years, we have seen the correlation fluctuate from going to very positive to negative. And the last 25-year period between 1999 and 2024 has caused a bit of a recency bias with bonds and equities moving opposite of each other due to the low rate environment. We think that we are headed towards a more correlated environment, and we are seeing that over the last year or two, that we're seeing the correlation come back. This shows the importance of having an asset class that's negatively correlated with the traditional assets such as bond, equities, and cash. This next chart here will show you the correlation differences and the benefits here. So we've highlighted in yellow the Auspice Diversified Trust strategy. So this is a strategy that's going to be very similar to the one Genus is implementing and has a track record from about 2007. you can see that the correlation to traditional assets such as equities, the TSX is about negative 10%, and with Canadian bonds, it's negative 13%. We're also seeing that the correlation between one single commodity, such as oil, as well as the commodity index, which is just a long index, is also negative. So this shows that it's very uncorrelated and does help on the downside protection. When it comes to the risk and return of the strategy, you can see here the diversification benefits are shown. So this chart shows the risk and return, return on the bottom, and then return on the left and risk on the bottom. So to read this chart, if you look at where the blue dots are, if it's more left of the chart, it means it's less risky. And if it's more right, it's more risky. And the higher it is, the higher the return. If we look at treasury bills, T-bills over there on the bottom left, for example, we can see that the risk is very negligible, but the returns are also very one of the lowest on the chart. So when we look at the Auspice Diversified Trust, which is a long-short strategy, the strategy lies somewhere between bonds and equities when it comes to returns and risk. Its returns are similar to the TSX and emerging markets over the last 18 years, but the risks are more closer to the bond side. So when we put it all together in a portfolio perspective and look at it together, we can see that the blue line here showing the Genus Balanced Fund benchmark, which is just a 60-40 benchmark, has returned about 5.6% over the last 18 years. The commodity fund, on the other hand, also returned about 5.4% during the same period, which is the yellow line, but we can see that it moves opposite to the markets, providing that downside protection. When we roll it up together and add in a 10% exposure, despite the two returning similarly, we can see we get about a 0.8% boost in annual return with a lower volatility going from about 12.7% to 12.3% and lower max drawdown by about 5%. So the gap between the orange line and the blue line is showing the benefits of investing in commodities. Next, I'll pass it over to Steph to talk about some ESG considerations for the fund.
Thank you, Justin. Okay. So good morning, everyone. I want to share some of the journey of doing this fund. When we are first in the ideation stage for this strategy, we put in a lot of thoughts into the sustainability and impact aspects of the fund, including the selection of commodities universe and also the underlying investment instruments that will be used within the fund. And commodities, we know they are raw materials and also primary inputs into production or for consumption. They are also vital inputs into the society, supporting livelihoods and other economic activities, providing positive social, environmental, and economic benefit. Some of this social benefit could be coming from, for example, commodities being economically accessible food staples, feeding global populations, and also providing food security. And then environmental benefits could be coming from some of the commodities being essential inputs for a clean tech and green energy transition. Economic benefits could be coming from production of commodities, supporting livelihoods of rural communities, and also the workers and farmers, especially those in low and middle income countries. So also as an asset class, as Wayne and also Justin mentioned, with this distinctive characteristics, having lower correlation with traditional asset classes, it is an effective tool for risk management, in addition to the portfolio to increase diversification and also inflation protection. So for our framework, to assess the impact of a commodity, one of the most important things to consider or to determine is whether the impact is structural or non-structural. Structural impact are those that are related to the inherent characteristics of a commodity or the structural elements of a commodity life cycle. This is not so easily changed. Non-structural impact is often as a result of companies' practices and policies on how they consume or produce a commodity. And these are the impact that could be improved or avoided altogether. And for us to, we wanted to take a holistic view of the impact of a commodity. So we look at impact through the lens of commodity life cycle. from the extraction production stage to the utilization and sometimes for some of the commodities being recyclable. Considering all the social, environmental, and economic impacts, whether they're negative, positive, structural, or non-structural. In the production and extraction stage, often we're more familiar with the negative impact, for example, the negative environmental impact from unsustainable methods of extraction, production, highly energy-intensive production processes, or on the social side, sometimes worker or labor issues throughout the supply chain or adverse impact on communities. These impacts are more non-structural in nature because they could be improved or avoided altogether with more sustainable practices, better policies for labor, and also community management. And there are also positive social and economic impacts from extraction production, including supporting lives of farmers and workers, and also sustaining rural communities and their local economies development. On the other hand, on the utilization stage, so there are positive and negative impacts. On the positive side, for example, environmental positive impact coming from some of the transition metals, helping green energy transition, and some of the metals being recyclable. However, on the negative side, environmental impacts are coming from the burning or utilization of fossil fuels. And on the other hand, there's also other social and economic positive impacts, including feeding global populations and enabling the growth of clean energy industry by transition metals. So the environmental benefit or the harm that we talked about from fossil fuels and also transition metals, they are more structural in nature. They're structural to these commodities. So it is quite important to distinguish between structural and non-structural impact of a commodity. As I mentioned, structural impacts, they cannot be avoided, but non-structural impact, those can be improved or avoided with better practices and policies. And for us, for our analysis, we put more emphasis on structural impact than non-structural impact. One of the key commodity discussion is around fossil fuels and also transition metals and their role in the energy transition. Here, we take a deeper look to see how they fit in, these two categories of commodities, how they fit in into our fund. For fossil fuels, as we already discussed, due to the inherent negative structural environmental impact from the utilization or burning of them, and no matter how you burn them, they still emit greenhouse gas emissions that are harmful to the climate or environment. And with the need to move away from fossil fuels to cleaner energy alternatives, so the fund is restricted from having long positions in these fossil fuel commodities, but short positions is allowed because they play a very, very essential role in hedging downside risk, especially during market drawdown or downturn. And at the same time, these short positions are not driving positive price dynamics that could encourage fossil fuel development. On the other hand, for metals, a lot of the metals, they are also referred as transition metals, and they are essential inputs for the renewable energy development, grid infrastructure, electrification, or battery energy storage. These environmental impacts, they are enormous, enormously positive and highly critical. However, there's also negative impact coming with the extraction of metals. It could be the negative environmental impact or highly carbon or highly energy intensive processes. And but these negative impacts, it's more non-structural in nature because they can be improved or avoided altogether with better environmental impact management, better more sustainable mining practices, and better community engagement and labor policies. So the structural positive impact outweighs the non-structural negative impact. That's why most of the metals within, we allow both long and short positions within the fund. So with that, I also want to highlight the point where, this strategy invests to get different, to get exposures to different commodities through commodities futures. It does not own the underlying consumers, producers, or companies that are consuming or producing these commodities irresponsibly. So the fund does not own or contribute to these negative impacts as a result of these companies' irresponsible practices. Here is a list of exclusions of some of the commodities that we apply on the universe of the fund based on our total impact considerations. The first one being cattle. Cattle is the most carbon intensive livestock. It is mainly because they are highly methane intensive from cattle's digestion. Cattle alone account for 65% of total livestock emissions, and livestock emissions accounts for about 15% of global emissions budget. And methane is way more potent or heat trapping than carbon dioxide over any time span. So with that consideration, and we have excluded cattle. Crude palm oil, given the lack of direct positive impact on feeding the population or sustaining everyday livelihoods, and also they are typically linked to labor abuses, displacement of environmental impacts due to their land use, water use, and also GHG emissions. And so we have excluded it, but we have included coffee Robusta, given their lower environmental impacts. Cocoa, this is also something we have excluded given their very widespread and very deep-rooted issues with child labor and forced labor, and also linked to poverty issues. And they also exert very high negative environmental impacts from the production. So this one we have excluded as well. For metals, lead is excluded due to its high toxicity. And for oil and gas, we have already mentioned long positions are not allowed, but short positions are allowed for the downside hedging benefits, while we are not encouraging positive dynamics, encouraging fossil fuels development. So as Wayne also kind of mentioned, we have seen more and more at sustainability-focused institutional capital and asset owners, they are incorporating commodities into their overall portfolio. One example would be Concordia University. They have recently integrated commodities into their intergenerational fund, which is 100% sustainable. And this is also partnered with Allspice for the launch of this strategy earlier this year. So with that, I will have Wayne to give us a kind of a broader perspective.
Okay, thanks, Steph. Well, in closing here, in summary, with the addition of our commodity strategy, I believe we provide one of the broadest spectrum of products in the value space in Canada. I think we have product spectrum dominance. Really, no one else offers this. With the addition of the commodity fund, we're also adding another alternative. We hope to add another one next year. We think this fund is also versatile enough. We put a lot of thought into the construction of this, and we think it's suitable both for value-focused investors and for more conventional investors. And so we think it serves both markets. And coming in 2026, we're going to launch a new hybrid impact equity fund. It's in the alternative category, and it's meant for. There's been a big demand by clients that don't have a lot of capital and to get exposure to private impact equity and private impact debt. And we think we have a way of doing that by combining both public and private together in a portfolio to create more liquidity. Most wealth management clients like more liquidity, and so we think this fund will address both liquidity and give our clients exposure to this impact, the private impact space. So we hope to launch that sometime next year. And that's our presentation. We'd be pleased to answer any questions you may have right now. So you just go to the chat and add questions. We have one question here I see right now. What do you expect to trigger the bear market? Well, I'll jump in, and Justin, you can add some comments if you want. Well, there's many things that can trigger a bear market. For example, in the internet bubble in 2001, it was just a weight of valuations that started to crumble. And that actually then started impacting some of the startups in that space who couldn't use their capital, their valuation of their capital to buy routers and everything else. So this collapsed on itself just from the weight of sheer valuation. I think we're in a bit better shape today. A lot of the hyperscalers and the tech companies are generating lots of cash flow. Their valuation's not as extreme as they were. The overall market, though, is is highly valued just based on, and a lot of it's based on the AI, but we're getting much bigger growth now than we were even 10 years ago, predicated on the boom there. So our models are still positive. Other things that can cause a bear market could be, a very deep recession could cause one. Also, a debt crisis could also cause one. So there's many things that can cause trigger a bear market. Justin, any thoughts there at all?
No, I think you make a good point. There's a lot of high valuation, especially with the AI. So that's something we're definitely watching closely there. There's been a little bit of pullback here and there, but still very highly valued, and it just keeps going.
Yeah. And so here's one for Justin. What percentage of my portfolio should I hold in this new commodity fund?
Yeah, so the target percentage that we have modeled based on is the 10% exposure. Any lower that we've done, given our back test, it didn't add enough value. So our target is around 10%, 10 to 15%.
Okay. And will the presentation slides be shared later? Yes, they will. I presume they will. We always share them. What would be a reasonable percentage of adding the commodity fund to mainly an equity-focused portfolio, Justin?
Yeah, so across all of our client base, we have we have added around 5 to 10%, just depending on how much equity you own. We do like the downside protection. There's almost an argument you should be owning a bit more commodities if you have more equities due to the negative correlation nature of the product. But we have added about 5% in the more equity-focused portfolios.
And here's a jump ball for either of you. Do you have any idea how your ESG restrictions will impact the negative correlation to your 60-40 returns?
So when we have run our back test, excluding the using our ESG screens and excluding longing oil, we were actually surprised that the performance, and so was Auspice, the performance was very similar, if not better, with our strategy than a strategy that they have live that we have shown today, their Auspice Diversified Trust. So it actually doesn't change too much, which makes a bit of sense because energy tends to take big hits during those periods. So we're still getting that exposure of going short.
Okay, and what will keep the bull market running? Want to take a crack at that, Justin? I can jump in after.
Sure. I think the government spending is, and as well as the consumers, those are the two big things that are keeping the markets afloat, as well as the economy. So government spending especially has been going up. We all know about the U.S. debt issue, and Congress has to pass another spending bill soon. So we'll see what happens there. And then again, the consumers still are very resilient. They're still spending quite a bit, especially on the leisure activity side. So consumer confidence still isn't being too hurt with the labor market still strong in the U.S.
Yeah, I just think, prosperity is what we need. In other words, we need low inflation. We need the governments to get a grip on their debt, and for some of the wealth in the economy to flow into the middle class, and keep the consumer going there. That's we've got to limit the debt and create things and create prosperity and real wage growth. I think is pretty important. Does Genus have a forecast for precious metals, Justin?
For precious metals, we have seen gold continue to go up. I think it's almost close to 4,000 or getting there. We have seen it continue to go up, so we expect gold to continue to be a bit strong there. In terms of the more of the economic sensitive metals, I do think that there is some upside potential there for that, especially if the economy resurges, the global economy with all the infrastructure spending and all the more nationalisticness we're seeing across the countries and investments into the infrastructure.
And we have also models for oil, gold, and copper. Those are neutral right now. There's no bells ringing there. But remember, this strategy is meant to help to do well when the stocks aren't doing well, and it's good diversification. Next, so we have a note here. Laura, recording of this presentation will be sent to all registrants and made available for replay on our website. So there's a question here, I think, for Justin. Auspice funds consist of ETFs, correct? Spot prices only. Would Auspice change which ETF to hold as green commodity launch? As blockchain allows tracking the green quality of a commodity, for example, coffee sourced from green growers with a unique spot price.
So when it comes to Auspice, the fund that we have created is not an ETF fund. It's a futures-based fund. So Auspice is invested just in pure futures contracts, which are expiring from 3 months to 1 year. And then it's not an ETF strategy, and we're not invested in one of their funds. It's a fully segregated account mandate that we have done back tests for, and based on the universe that we have selected there. And then with the blockchain, I'm not sure, Steph, maybe?
Based on the current, because the fund is using commodities futures. Commodities futures, so far, the market is not developed to distinguish between different types of growers for coffee, for example. So unless new innovation has developed for the futures market, which I don't think in the near term will be, so it's quite hard. I don't foresee that will happen.
Which requires more telemetry and data for that.
Mm-hmm. And also you have to have a good size for the market, the scale for the market to happen.
Okay. How would the fund have changed Genus performance in 2022 and other past years? Well, and you can jump in here too, Justin. We showed you the Auspice performance, and based on just putting together their actual fund, which was mixed with our benchmark, it improved it by, it was 60 basis points, I think, Justin. We think that's
80,
yeah, is it 80 or 60? Okay.
80.
Somewhere between 60 and 80, so in that range. It's simply a back. There's no guarantees, but we think it's going to add value, but also protect downside and diversify and help us if we do get to a bear market at some point in time. I don't think we have exact 2020, and it's just based on past performance. There's no guarantees there. Okay, any more questions? Okay, well, thank you all for attending and for your interest in this new strategy. We're excited by it, and we think it's going to help our clients earn higher returns over longer periods of time. 60 to 80 basis points is adding value. It accumulates over a 10-year period. We're very, very excited about that. So thank you all for attending, and we'll see you at our next seminar.